Welcome to this deep dive, designed for you, the learner. Today, we're getting right into a really fascinating discussion. It's all about Trump's tariffs. We're going to unpack the thinking behind them, what they're intended to do.
And their potential impact, right, on the global stage, but also how they connect back home to big things like America's debt and, economic growth.
Exactly. And our source for this is a really engaging recent conversation featuring Chamath Palihapitiya.
Yeah, he's known for having some, shall we say, sharp perspectives, often unconventional, and his take here is definitely thought-provoking.
No doubt. So our mission today is really to cut through the noise. We want to extract the core arguments.
Like, what's the actual strategy with these tariffs? How might they affect trade balances, the global economy?
And specifically, what are Chamath's key insights on the nation's financial health, in this whole context?
We're aiming for those aha moments.
Precisely. So let's start at the beginning. Why? Why were these tariffs implemented in the first place?
Well, the conversation we're drawing from points to decades of globalization.
Right.
Especially after China joined the WTO. That was around 2000.
Right.
And American companies started shifting manufacturing overseas. A lot of it.
Why? Lower labor costs, right. The example used was athletic shoes, maybe $25 an hour labor here versus, much cheaper in China.
Exactly. And while that meant cheaper stuff for us to buy.
Which people liked, obviously.
Of course. But the less visible side effect was this kind of hollowing out. That's the term used.
Hollowing out the American middle class.
Yes. And creating this over-reliance on other countries for essential goods. We didn't really notice it, maybe, with the cheap goods masking it.
Until something like the pandemic hit.
Precisely.
Yeah.
COVID really exposed that vulnerability. Big time.
Yeah. And beyond that vulnerability, there's also this whole argument about fairness in trade, isn't there?
There is.
Yeah.
The U.S. buys so much stuff from the rest of the world. Huge consumer market.
But when we try to sell our products overseas,
often you run into taxes, barriers, hurdles. It's not always the same open door that foreign goods get coming into the U.S.
So that leads to the objective of the tariffs. The view presented is it's about making trade, quote, more fair, or maybe more proportional is a better word.
That's the argument. Not necessarily strict reciprocity like a mirror image. The term reciprocal might have been a bit of a linguistic misstep.
So proportional meaning?
Meaning, if country X taxes our widgets at 10%, maybe we should impose taxes that have a proportional impact on their goods coming here. Level the playing field in terms of overall effect.
Okay, that makes sense. But it's not just about fairness, is it? There's another major goal here.
Absolutely. A huge second goal. Boosting American self-sufficiency and national security.
Which ties back to what you said about the pandemic exposing fragility.
Exactly. We realized we couldn't easily make critical things here anymore. Pharmaceuticals, certain technologies, computer chips.
Key components.
Very key. And there are specific examples given, like rare earth minerals essential for EV motors, mostly controlled by China.
Right.
Or large-scale battery production, dominated by just 2 Chinese companies. That kind of dependence, it raises strategic questions. Big ones.
So the tariffs, from this viewpoint, have this two-pronged potential effect.
Yeah. 1, maybe realign the world order a bit. Make countries realize the benefits they've had from access to the U.S. market.
And 2,
incentivize bringing critical industries back home for resilience, for security.
Got it. Now, there was criticism, wasn't there, that maybe the tariffs were applied sort of haphazardly, just targeting trade deficits?
There was that criticism, but the perspective we're looking at argues against that. It says the goal was broader, a bigger recalibration.
And trying to stop countries from just routing goods through other places to avoid the tariffs, like the Mexico example.
Exactly, trying to prevent that kind of circumvention. It's about the overall structure, not just one bilateral deficit.
Yeah. Okay, so that covers the why self-reliance rebalancing trade. Let's shift gears now. What about the impact? How might these tariffs actually affect trade deficits and global markets?
Right. So first, just to be clear on trade deficits, it's when you import more than you export. U.S.-China is the classic example. We buy way more from them than they buy from us.
And deficits aren't automatically bad, right?
Not necessarily. They can reflect strong domestic demand. But the argument is the U.S. should have the flexibility to manage them strategically, not just let them happen passively.
But couldn't this backfire? What's the risk here globally? Could China just make better deals with other countries and leave the U.S. sort of isolated?
That's definitely a potential risk, a concern that gets raised.
Right.
But the counter-argument focuses on America's unique leverage.
Which is?
The consumer market. It's unparalleled. The size, the spending power. No other single country drives that level of demand. That's a huge bargaining chip.
So the idea is other countries need access to the U.S. market.
That's the leverage. And this leads to that concept you mentioned earlier, this trading NATO idea.
Right. What exactly is that?
The vision is basically a new global trading alliance. Countries that agree to play by certain rules proportional, fair trade, they get preferential access to the U.S. market.
So it's an incentive to cooperate, join the club, get the benefits.
Exactly. It would aim to create a bloc of nations aligned on these trade principles.
Okay. Let's talk jobs. That's always a big question with trade policy. Will these tariffs bring back all those manufacturing jobs that went to China?
Well, the perspective here isn't necessarily about bringing back every single job that was lost, like for like.
Okay.
It's more about stimulating new, well-paying jobs in critical sectors here in the U.S.
Like what kind of sectors?
Think infrastructure. Power utilities, for instance. They have an aging workforce, huge need for skilled people. Or advanced manufacturing nuclear submarines were mentioned. Highly skilled, high-paying work.
So it's about future industries, critical industries, not necessarily recreating the past.
That seems to be the focus.
Yeah.
And it connects to the skills gap, the need for more vocational training to prepare people for these specific kinds of jobs.
Right, matching skills to the needs of these growing domestic industries.
Okay.
Now, let's pivot to another really critical piece of this. Chamath's views on America's debt and economic growth, especially how tariffs fit in.
Yeah, this is a big one. So the national debt, basically, the government spending more than it takes via taxes year after year. It borrows the difference by selling treasury bonds.
And that's added up to a lot.
A substantial amount, yes. And the problem isn't just the total number, it's the interest payments.
Like a maxed out credit card.
Exactly. A big chunk of money just goes to servicing the debt, paying interest, not even touching the principal.
And there's refinancing risk too, right?
Huge risk. The Treasury is constantly rolling over trillions in debt as old bonds mature. If interest rates are higher when they need to refinance.
It costs more to borrow. The interest payments go up even more.
Precisely. It makes the whole situation more vulnerable.
So how do tariffs possibly connect to this? Specifically to bond yields, the interest rates on that government debt.
Okay, this is an interesting argument. The idea is tariffs can create uncertainty, especially in the stock market.
Right, markets don't love uncertainty.
So when investors get nervous about stocks, where do they often go?
To safer assets, like treasury bonds.
Exactly. So increased demand for bonds can push their prices up and consequently push their yields down.
So tariffs causing stock market jitters could actually lower the interest rate the government pays on its debt.
That's the potential dynamic presented. It could inadvertently make borrowing cheaper for the U.S., at least theoretically or in the short term.
What about the idea that a country like China might try to mess with this, dump U.S. treasuries to deliberately push yields up?
Well, the view expressed is that while you might see short-term yield jumps after big news, the idea of a country like China orchestrating a massive, sustained sell-off to manipulate yields long-term, it's considered pretty unlikely.
Why? Too big a market.
The U.S. Treasury market is just enormous and very liquid. A move like that would be hard to sustain, and it could actually hurt the seller, too, by devaluing their remaining holdings.
Okay. Now, the conversation also mentioned this Maggie versus Mag 7 idea. What's that about in this context?
It's highlighting a difference in stock market exposure. The point made is that a large part of the population, maybe the working and middle class, sometimes labeled the MAGA demographic in this context, doesn't have huge direct investments in the stock market.
Unlike, say, people heavily invested in the big tech Mag 7 stocks or the broader market.
Right. So if the stock market takes a dip because of tariff uncertainty, it might not directly hit the finances of that broader group as much. The focus in this view is more on their wages, job opportunities, cost of living.
And how does this contrast with the previous administration's approach to the market?
The argument is that the Biden administration focused heavily on keeping the stock market buoyant, partly by keeping money cheap and refinancing debt in the short term.
Which kicked the can down the road a bit.
Well, it created a situation where a lot of that short-term debt now needs refinancing, potentially at higher rates. That's the challenge highlighted.
Okay, back to tariffs specifically. The big fear for consumers is always inflation, right? Won't these just make everything more expensive?
That's the immediate concern, yes. But the perspective offered differentiates between a price shock and ongoing inflation.
How so?
A tariff is seen more as a one-time price shock. The cost is added at the port, so the price of that imported good might jump once. It's not necessarily the same as inflation, where prices across the board keep rising and rising over time.
But even a one-time shock hurts the wallet. Is there any potential way to offset that for consumers?
This is where a really interesting, though theoretical, idea comes in.
Okay.
The argument is that the revenue generated from the tariffs could be substantial. Potentially enough, it's suggested, to eliminate federal income tax for people earning under, say, $150,000.
Wow. So the tariff money could fund a big tax cut.
That's the potential offset mechanism proposed. It would, in theory, cushion or even outweigh the initial price increase on imports for many households.
Yeah.
But again, it's theoretical. Depends on revenue, policy choices.
A lot of ifs, but an interesting concept. So tariffs as a revenue source. But for truly tackling the debt long term, what's needed?
Revenue helps, but the fundamental driver, according to this view, is economic growth. Real, sustained growth.
Driven by?
A skilled workforce in high-value industries. So investment in people, training, innovation, that's key to growing the economy enough to actually shrink the debt relative to GDP.
The conversation also mentioned DOGE, government waste.
Yeah, that was a shorthand, perhaps humorous, reference to identifying and cutting potentially wasteful government spending. The idea being that those resources could be used more productively, either invested elsewhere or used for debt reduction.
Okay, so let's try and synthesize this. Looking ahead, what are the potential scenarios? What's the optimistic outlook from this perspective?
The optimistic case is tariffs work. They lead to fairer trade deals. Critical industries come back, boosting the domestic economy. We become less reliant on adversaries. And maybe that tariff revenue funds significant tax relief. Trump gets to rewrite global trade rules. The Mar-a-Lago Accords idea was floated.
A pretty rosy picture. What about the pessimistic view? The potential downsides?
The pessimistic scenario is that the tariffs just create uncertainty and friction. Businesses hold back investment because they don't know the rules of the game. It chills the economy, maybe leads to a slowdown, even recession, negative growth. Things go sour.
So, high stakes. It was also mentioned that the current administration is seen as more accessible to business leaders.
Yes, the contrast was drawn. This administration is portrayed as being more willing to talk, to listen to business leaders about the ground-level impacts of policies, compared to perceived difficulties in getting that kind of engagement previously.
Interesting. And finally, what about China's situation in all this? They're not just standing still.
No, definitely not. The conversation notes that China, while powerful, has its own challenges. Long-term, there are demographic issues. The declining birth rate is a big one.
And more immediately.
A key indicator mentioned is a drop in foreign direct investment, FDI. It suggests foreign investors are maybe less confident about stability and returns in the Chinese market right now.
So they have their own economic headwinds to deal with.
They do. And this dynamic, the argument goes, might actually strengthen the U.S. position.
How so?
The belief is that many countries, seeing the U.S. push for proportional trade and perhaps seeing China's own issues, will be incentivized to cut deals with the U.S. to secure access to that huge consumer market.
So waiting to negotiate could actually give the U.S. more leverage.
That seems to be the strategic calculation discussed. Let the pressure build, and countries might become more willing to agree to terms favorable to the U.S.
It really sets the stage for a potential shakeup in global trade.
Absolutely. A period of significant change, potentially.
So wrapping this up, we've covered a lot of ground today on this deep dive into Trump's tariffs. We looked at the goals that push for self-sufficiency, rebalancing trade.
Yeah, and the potential impacts on trade deficits, global markets, and how it all intertwines with America's debt picture and economic growth, drawing heavily on Chamath Palihapitiya's perspective.
Right. So the question for you, the learner, to consider is, are these tariffs a necessary jolt to an old system that maybe wasn't working for everyone? Or do they risk backfiring, creating more problems than they solve?
What parts of this discussion really clicked with you? Or maybe raised more questions?
Think about that idea of using tariff revenue for tax cuts. Does that seem feasible? Where do you see U.S.-China economic relations going from here? Lots to chew on.
Indeed. Thank you for joining us on this journey to get more informed. We hope this deep dive has given you some valuable insights and maybe sparked some curiosity to explore these critical issues even further.